Good morning. Good morning. This is a little an analysis summary that I'd like to provide. It's on the Nasdaq futures. You know the deal. I'm looking at when to add to winners and trail my stop. Okay, this came originally from me adding to winners. I discovered one day adding to winners and trailing my stop. Even though I'm up like, let's say $500 on the trade, I'm like, wait, no. I don't want to add to this because it destroys my average price. Whatever. Okay. And I'll bite the bullet. I'll add to the position. And now it goes down. It goes down to break even fairly quickly because my average just crept up so much and stuff. And then it ended up going my direction, positive 750. 1250. I'm like, whoa, wait a second. I am controlling double size. Interesting. For the same risk that I had originally. Interesting. Now we're getting somewhere. Which led me to a consensus that, all right, trailing to stop, adding to winners is the way to go. And quickly did I realize that it didn't work. What do you mean it didn't work? I mean that I was doing it on dull days. I was trading, adding to winners, trailing my stop, and I was getting chopped apart. Oh my goodness. And it's in my videos somewhere. Oh my gosh, I was so pissed. I remember I was so mad. I wrote in my journal that, where is it? Trading days. Oh my gosh, you got to see this. I won't. It's a long video, but where is it? I lost gobs of money, bro. Gobs of money. I lost, I think it was $10,000. Cuz I made 10 grand from adding to winner, trailing my stop on a volatile day, and then I did the exact same thing the next day. And I said, all right, this is what we got. I know what to do now. And then I got torn to pieces. And I was following everything. And I got torn apart, bro. I lost 10 grand doing the exact same thing as how I made 10 grand. And I wrote in my journal, freaking caps, all caps, fuck you. Fuck life. Fuck everything. Why is I do the exact same thing and you give me the exact different opposite result? I follow my plan and I still lose money? Fuck you. All this. And I'm like, dude. Now after months go by, which, this was, I don't know how long ago. I don't really know how long ago. A year ago. Which leads me to now. I'm thinking, well, I'm just going to create a system that does what I was doing. I'm just going to create a system that trails the stop and adds to winners. Or doubles down on losers and trails my target, which is the complete opposite. So I actually just test one of them, which is trailing stop and adding to winners. And if it provides a negative performance, we know that mean reversion works better. We know that doubling down on losers works better if it loses money. And do you want to know the answer? The answer is that they're both even. I'm talking over a large amount of trades. It's break even. And I've said that before. I've said that before. It's just how amazing it is that it's equivalent. It's like somebody's been here before. It's like that the market is already monitored like that. And that's what it is. I split the market into increments and I just buy and sell based on, it's a stop and reverse system. And if it trails you can trail your stop, and is the market more fluid, even on the higher time frames, it's still very close to equivalent edge. So very close to equivalent edge. Okay. There's some outliers. Okay. I'll be honest. Crude oil is a little bit more, it's a little bit better to trend. in the mornings. And then on the ES, on the smallest increments, on the very tiny increments on the ES, the stock market, it is mean reverting. It is 0.14 R per trade mean reverting, which is, $14 if you're risking $100 a trade. In general, over the average, over many, 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 many trades of a huge sample, it is negative performance to add to your win or trail your stop on the small increments of the stock market, the ES. Anyways, so long story short, I devise a system that can add to winners and trail my stop, and I just want to track the performance, and here it is. Forget all the words on the screen, just look at the image of these data bars, okay? There's big data bars, and then it goes down to small data bars. These data bars represent the morning session. These data bars represent the volatility of the morning session. So you can see that these small days, let's take a look at the date. If you look at September 12th, if you look at September 24th, these were small opens. You look at July 11th. These are small opens. These are very low energy from 8:30 a.m. open to 10 a.m. So that first hour and a half that the market's open, it's smaller energy. It's just small energy, okay? Now, I track the performance of trending that market, of risking 1 to make 7 or plus, of adding to winners. So it's just adding to winners, trailing your stop. And I track the performance after we see that the market was volatile or not volatile. Remember, this data on the data bars come in at 10 a.m. every morning. I get another data point every morning. Now, I don't start taking trades until after 10 a.m. And I do this for a reason, because I want to be able to trade this. I want the data point to arrive, and then we see, should we turn it on or off? Should we have it on or off? So I want the data point. So all the trading on the P&L here happens after 10 a.m. Okay? So what are the results? I'll tell you what the results are. Adding to winner and trailing your stop on aggressive mornings is better than adding to winners and trailing your stop on the lower end here where it's low volatility. So let's look at the low volatility. Let's look at, the lowest volatility up to, 40 to 20, it looks like. What do we get? We get negative 3,700. You keep going to the median, which is 62. Up $1,000 in 42 days. This is negative edge to zero edge. It's just bad performance. You see this on a chart. Look at all the red. Look at all. Okay, there's a few green days. A 10 grand day. It happened to just move in the middle session, even though it was a shabby morning session. But overall, you're losing money or break even. Okay. Now let's look at the upper section. You see those big data bars. We're going to grab all those. And we're going to grab all that up to 90, because that's when it kind of dwindles away. So we want that upper chunk. This is more than the median, which is 62 down here, which is down here. This is the median down here. It's a little bit less than the upper quartile, which is if you split all of this data set into 25% increment, 25 percentages, the upper 25%, this is including probably the upper 33%. Okay. What do we get? 29 grand. You make 30 grand, which this profit and loss is based on adding to winner and trailing your stop. What does this mean? It means that the morning session predicts if it's going to be a time when you can add to your winner and trailing your stop. That's what this means. So if the morning session's volatile from 8:30 to 10, this is statistically significant in my opinion, because not only did I track the 10s, which is 10-point increments, I tracked the 20s, and it has the same results. It has the exact same results. You can go to 30 here. You make 41 grand doing higher time frame trading during this time. And then on the lower side of the spectrum, you made 40 grand now. In the lower side of the spectrum, you make break even to a little bit more. You get a little bit more, 8 grand. So that's what happens. Okay, including that lower time frame. And then it goes -4 grand all the way up to the median. So in general, it's only profitable to trail your stop and add to your winner when the morning session is more volatile, period. And there's a lot of different ways to measure volatility. There's increment counts. There's range, of course. There's volume. You can do a combination of these. You can do a lot of different ways to measure volatility. But in general, I think you can't go wrong with this consensus that, dude, when the market is volatile in the morning, you generally don't want to add to losers during that day. You just don't generally want to do that. Sure, you can make money sometimes. Sure, sometimes it does work. Look at that. March 5th it worked. March 13th it worked. But in general, you don't want to do that because there are more times than not you're going to make money trending that market. Going for bigger moves. Add to win or trail your stop. Add to win or trail your stop. So that's the time to do it. So I hope you enjoyed that analysis, and I hope that makes you a better trader. Dun 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 dun. Yeah. I think that's all I had. Yeah, I just want to make that point. I think that's a pretty clear and abundant point, dude. There's plenty of data, plenty of days. That makes sense to me. Makes sense intuitively, which I think is important too. If you understand your system, you kind of understand the concept behind it, and the concept checks out intuitively. Oh, aggressive. Oh, that means you shouldn't double down on losers. Okay, like it makes sense. It's connected to do that. So, and then the data itself backs that up. So that's why I had to share it. So, all right, that's it. Carry on. Peace.